Hello friends, welcome to our lecture series on financial analytics. This is Aditya P. Tripathi. I am going to discuss today with you another interesting topic of financial analytics, that is financial modeling. In today's lecture of mine, I have planned to discuss with you what is financial modeling all about, the meaning and definition of it, and then we shall be talking about types of financial models. What are those models which we are going to develop, or what you call create those models in order to achieve our goals of resorting to these techniques of financial analytics, and further we'll talk about the steps to create financial models. So very frequently we have been using this term financial modeling, and learners are quite often asking us, sir, what is this financial modeling and what exactly we are doing into these modeling, what kind of model we are preparing, and what is the basic agenda behind preparing or creating these kind of models. So financial models are basically there to achieve certain goals, of course related to our accounting and finance. We have to achieve certain goals, and for that we are developing those models. So I shall be telling you one by one what are those goals, what is financial modeling, what are the different types of financial models we are resorting to, and what are the steps to create financial models. So let us first talk about what is financial modeling. If somebody is asking you, what do you mean by financial modeling? So financial modeling is basically the construction of a spreadsheet model, which is giving you a kind of illustrative example of companies' likely financial results in quantitative terms. You wish to know the likely financial performance or the results of a company in a quantitative terms, and for that there is a spreadsheet which is created, and we call it spreadsheet models, and it illustrates the company's likely performance or financial results in quantitative terms. So in financial models we can simulate the effect of specific variables so that the company can plan a course of action. So our objective is that we are simulating the effect of specific variables. And what is the objective behind simulating those specific variables? Because we have to take certain corrective steps, or what you call as what is your next plan of action. So unless I know what can be the possible outcome in future, I cannot decide, or I cannot design a future course of action. So in order to design a future course of action, we need to first know what is going to happen, what can be the likely feature or picture of the specific financial situation of my company, and then only I can plan a specific course of action related to those variables. So basically this is something which makes the requirement of which makes creation of such kind of models very significant, because the beauty of models are that they are not only telling you what can be the likely performance or financial results of your company in near future, but they are also giving you the effect of specific variables, that you can simulate that what will be the impact of this specific variable. Suppose if you have 5, 6, 7 variables, you can easily identify that what is the magnitude of this variable, what is the comparative strength of this variable, which one is more significant for me and which one is less significant for me, and accordingly we can plan a future course of action. I shall be giving you examples when I'll tell you about the types of financial models. I'll exemplify that see, in this kind of scenario, these are the possible variables which we are going to identify. We are able to understand that these variables are there, and this is the comparative strength of this variable, and accordingly we can take a course of action, the future course of action. So it is basically a process by which a firm is constructing a financial representation of you can say some or all aspects of the firm according to our requirements. Sometimes we are taking only one aspect of your company or your firm, or at times we have to have the holistic picture of our organizational performance. So according to our requirement, we are developing a model which is basically nothing but constructing a financial representation of that specific aspect for which you are conducting or creating this model. So the model is usually characterized by performing calculations and eventually giving recommendations, which is based on the information which you have identified while developing that model. So this model is not only giving you the calculation, but also helping us in giving recommendations which is based on that information. So of course, when I'm giving some recommendation, that need to be supported by or validated by certain facts and figures, and that factual recommendation is very much required, and for that only we are having these models which are in place. So this model may also summarize the particular events for the end users, say for instance investment management returns, or it may also help in estimating market directions as well. I want to know the market direction of my product in future, and I have developed a model so I can easily identify that given these variables, this will be the direction of the product in which I am dealing with, and accordingly I can plan the results. So it is helping me estimating the market directions as well. I can realize that, see, this is going to be the direction of the market in which I am dealing, and this is the reason why these financial models, they have become very trendy. The companies are increasingly resorting to these models because they are finding it so useful that on simply having they have to simply run a program, and they are having this knowledge that what is going to be the future of my product, the market in which I am dealing, what are the variables which are going to change, the kind of change which we have to resist, or with which we have to bear with, and there are certain controllable factors, there are certain uncontrollable factors. So how to deal with those uncontrollable factors? If we have this information beforehand, we are not meeting with an accident, rather we take it as an incident. So there is a difference between accident and incident. Suppose if I have an idea that the weather is going to change, so I can plan accordingly. But what if I don't know that the weather, that by what time the weather is going to change? Of course, it can cause some impact on my health. I may suffer. Likewise, in business also, in business enterprise also, if we are somehow able to simulate the future direction, if we are able to identify what is going to be the future direction of the market in which I am dealing with, it will definitely improve our overall performance, and of course the profitability, which is the ultimate goal. So this was basically a brief introduction of financial modeling, that what is financial modeling, what we do into that, what is the intended outcome. But when it comes to defining models, we get the input from those meanings which I have already explained to you, that it is a process. Developing a financial model is basically a process by which a firm is constructing a financial representation of some or all aspects of the firm or given security. It can be a firm, it can be a given security, or it can be anything for which you are developing that model. And this model is usually characterized by performing calculations and making recommendations based on that information. So you have to, it's a multiple step process. You are constructing a financial representation of a specific aspect of a firm or a specific goal, and then that model is normally characterized by performing calculations. You are doing calculations into that and making recommendations based on that information which you have created. And this, it may also summarize that particular event for the end user and provide direction regarding possible actions or alternatives. You can also come to know about the alternatives, that this can be my future course of action, this is the possible alternative with which I can improvise my financial performance. Now, after knowing the meaning and definition of financial models, we should know what are the different types, what are the different kinds of financial model or types of financial models which are in practice, which we are using nowadays increasingly in accounting and finance. Because whenever we talk about accounting and finance, we are not only supposed to talk about accounting, but also the auditing, the taxation, the legal aspect of it. There are many more which in due course of our discussion will be discussing. So when we talk about the types of financial models, these are basically the various types of financial models which are used in accounting according to our purpose and need of doing it. Sometimes we have a purpose, we are having a purposive modeling, and accordingly we design a model because we want to have some information regarding a specific situation in order to solve a specific problem, and for that we are developing a model. And different financial models, they solve different types of problems. Of course, every model is intended is developed with some intended goal, with some intended outcome, and that we want this outcome, I want the solution to this problem, and for that I have developed a model. So of course that financial model is supposed to provide us solution to that pertinent problem with which we are suffering, or our institution is suffering, and we want to have a solution to that. So the majority of financial models, basically they concentrate on valuation, or some of them they are created to calculate and predict risk. Sometimes we are having a goal of calculating and predicting risk. Sometimes we have to track the performance of portfolio, so for that also we develop a model. Or at times we have to identify economic trends within an industry or a region, so for that also we are developing a financial model. So these are just some examples, some of the examples. There can be n number of models according to your requirement. So whatever industry you are dealing with, whichever industry you are working with, you have to first identify what is your problem, what is the pertinent problem which you are facing, and accordingly you decide that, see, I want to predict risk. My organization, suppose I am talking about insurance sector, I am dealing with a lot of risks. During COVID-19, most of the insurance companies, they were actually, they fell prey to this pandemic of COVID-19, and eventually, since everyone was falling sick, what they did, they said that this COVID-19 was not covered into their health policy. Because earlier there was no idea, there was no incident or evidence of such kind of disease. Flu was there, but there was nothing like COVID-19, which was so fatal. So most of the companies, what they did, they started offering, they did a calculation that what if I cover, what if I include, if it is not in the list of exclusion and I want to bring it to the list of inclusion. So in order to include that pandemic of COVID-19 into their health cover packages, they did a calculation. They must have done a financial modeling for that. That if I include this, what can be the possible risk? What can be the possible cost of including it into our health cover? And accordingly, what they did, they increased the amount of insurance premium also. So they must have done a cost benefit analysis that if I'm charging this much of premium, how many patients they are supposed to report, what can be the likely impact of it on our financial performance. Of course, when I say financial performance, it is both way. It is not only cost but also revenue, or it is not only revenue but also the cost. So it is only one example. So according to your industry in which you are working, you have to design, you have to decide that what exactly is your requirement, and accordingly you create a model. So if you are willing to calculate and predict risk, of course your model will be developed according to that. If you have to track the performance of portfolio, you are dealing with the security market, of course you will go according to that. Or you have to identify the macroeconomic trends within an industry, then your model will be developed accordingly. So according to your motive, you are going to develop a financial model. Now I'll be telling you about some most popular financial models which are being used by industry at large, and they are making good use of these models. The first one is, the most popular one is discounted cash flow model. It is just like we develop, we do the calculation of NPV under capital budgeting, and we are already aware of this term discounted cash flow, because under capital budgeting analysis, we have been exposed to these two types of situation: discounted cash flow technique and non-discounted cash flow technique. When we say discounted cash flow technique, of course we are indicating towards the acceptance of time value of money. We are considering the concept of time value of money. We are discounting the future series of cash flows at present value. So we calculate the present value of that specific cash flow which we are going to receive in near future. So discounted cash flow model is basically using or resorting to that way only. Among different types of financial model, it is the most significant and the most popular one, which is known as discounted cash flow model. And this model is based on a specific theory that the value of a business is the sum of its expected future free cash flows discounted at an appropriate rate. So there are three important things here. One is your future cash flows which you are going to receive. Second is what should be the rate of discounting, and third one is we are going to discount it. So I have to first understand what should be my discounting rate. We have to design or decide our discounting rate, and of course identify the free cash flows which we are going to receive in near future. So expected future cash flows, they are discounted at an appropriate rate. So we are doing a discounting, and then we are reporting that what will be the value of cash flow if we are discounting it at a specific rate. So here discounted cash flow model is a kind of realistic model which is giving me an idea that, see, this is my the cash outflow is going today, I am incurring cash outflow today, cash inflow I am going to receive in future, and that too is expected only. I cannot say with guarantee that I am certain about this cash inflow, and for that you are already aware of certainty equivalence method which we were using in capital budgeting. I cannot be very certain or sure about the future expected cash flow, so I have to somehow identify the rate of discounting, and accordingly we have to make adjustment for the expected future free cash flows also, that, see, this is going to be my future cash flows, and accordingly we plan. So discounted cash flow model is very significant and very popular one, very common one, and which is being used across the industries, whether you talk about the automobile industry or you talk about any industry, everywhere it is being used, because all of them, they are supposed to deal with their revenue, they have cash inflow, they have a cash outflow, so accordingly they are planning. So this is the reason why it is the most common model. Second one is comparative company analysis model. As the term itself is indicating, you are doing some kind of comparison. I want to know what is my comparative strength vis-a-vis other companies. I am working as a company in a specific industry. Suppose I talk about the automobile industry, I am company X, I am working in automobile industry. I wish to know that what is the strength of my competitors, what can be what is their strength, what is where do they stand, what they are doing, and accordingly we can plan, we can actuate ourselves that here we are standing. So it is also referred to as the comparable. It is also known as comparable analysis model, which is basically a comparative company analysis model, and it is one of the major company valuation analysis which is used in the investment banking industry. Most of the investment banking companies, they are using this comparative company analysis model, and in this method they are basically taking on a peer group analysis, under which they compare the financial metrics of a company against similar firms in industry. Suppose there are 10 companies working together in a specific industry, then they are doing a peer group analysis and they are comparing the financial metrics of that company. It can be the cost, it can be the revenue, it can be their result. Like nowadays, if you talk about insurance sector, there are certain websites which are providing you their claims settlement rate also, that this is their claim settlement rate, the success rate. That is also an outcome of comparative company analysis model. You are going to a specific site, I won't name that specific site because we are not supposed to do any marketing for those companies, but yes, you can realize that I'm indicating towards which kind of websites. There are certain websites, if you go to hotel industry, there are certain websites which are giving you a comparative idea. Even for the airline booking, there are certain websites where you go and find the comparative costing also. So when you do a comparative company analysis model, it can not only be for the revenue but also for the cost. As a customer, I wish to analyze the cost of a particular flight, and I want to know that on one page, on a single click, I should know that if I book by this particular airline, this will be my cost. If I change to this airline for the same journey, for the same destination, this is going to be the cost. The same is the case of hotel industry. And likewise there can be n number of examples. That is from the customer's point of view. But when a company is conducting this kind of comparative company analysis model, they are working on that. And now you must be understanding that in practical, how practical it is, how relevant it is, and how in it is. We are already witnessing we are making use of these models, knowingly or unknowingly. Whenever I have to book a flight, I simply go to certain websites and I do a comparison. I have to do a hotel booking. I go to a specific site which is giving me the comparative chart that if you are booking the same hotel by this portal, your charge will be this, and if you are changing the portal, your charge will be this. So how beneficial it is. For the same hotel, for the same destination, and for the same facility, if I am paying less, nothing like that. And that is what is basically the motive of this comparative company analysis model. Why I chose to give you an example of from the customer's point of view, because this is something which we are using. You may not be acting as a management accountant, but of course you are working, you are behaving like a customer. So as a customer, we are already making good use of that. Likewise, companies are also doing that. So it is based on an assumption that similar companies would have similar valuation multiples. For instance, if I talk about enterprise value, which is popularly known as EV to EBITDA ratio, that is earning before interest, tax, depreciation and amortization. So EV to EBITDA ratio we talk about, and it is based on this assumption that similar companies would have similar valuations multiples, and of course the enterprise value EBITDA is one example. So this was another type of model which is very much in nowadays when we talk about financial analytics. Another is sum of the parts model. The third one is sum of the parts model. What is this model? It is also referred to as a breakup analysis, because you are in a way providing a kind of breakup, a kind of detailed segment wise reporting you are giving a detail of a particular analysis, and whenever we need such kind of analysis we are making use of this kind of model, sum of the parts model. It involves valuation of a company by determining the value of its different divisions, assuming they were broken down and spun off, or at times they were acquired by another company. Suppose I assume that they are acquired by some other company and I want to know that what is my performance. For instance, before merger, SBI and its 7 associates, State Bank of India and its 7 associates, earlier they were there, now after merger they are not there and they are merged into SBI only. So before merger, what was happening? SBI was reporting its performance separately, and the financial performance of those 7 associates, they were reported separately. What was the motive? The motive was that this is the collective performance of State Bank of India as an entity, and what other associates are earning, that was given as a breakup. I just gave you an example of that. So it involves valuation of a company by determining the value of its different divisions. Suppose you are working in automobile industry, your company is working into IT and ITES sector, your company is also into garments. So you wish to break down and spun off, or you assume that if they were acquired by some other company, what will be the valuation of that specific company. So whenever we require the breakup of different segments, it can be the product wise analysis. For instance, suppose if there is a FMCG company, fast moving consumer goods company, and it is in the same segment in toiletries, they are having different brands. So for all brands, they can have sum of the parts model, that this is the most popular revenue generating product, and this one is the least revenue generating product, and accordingly you can plan a future strategy. So sum of the parts model is very much beneficial or useful for those groups which are having running different types of companies or different types of products, or they are working in different sectors. So for that, this sum of the parts model is very beneficial and it is being used by those companies. Next model in line is leveraged buyout model. We also call it LBO model, that we talk about the leveraged buyout. So I'll tell you under what circumstances this kind of model is being used. This LBO model basically involves acquisition of some other company using a significant amount of borrowed funds to meet the acquisition cost. So you have to meet some acquisition cost. There is some acquisition cost. Of course, I'm going to acquire a company, so I have to shell out some amount of money, and I want to know that if I'm acquiring some other company, what will be the significant amount of that borrowed fund to meet this acquisition cost? What will be that cost that I'm willing to know? And this kind of model is being used mainly in leveraged finance at bulge bracket investment banks. When we talk about bulge bracket investment banks and sponsors like private equity firms, and these entities, they are willing to acquire companies, and while acquisition, their objective is not to run that business. Their objective is to first acquire and sell them in the future at a profit. So these companies are basically acting as a buyer of those companies. In place of buying a product, selling it out, what you are doing, you are buying companies. You are acquiring certain companies, and then with an objective of selling them in the future at a profit, you are having this kind of calculation. So for that, we have leveraged buyout model, that I wish to buy a specific company and I want to know that how profitable it is going to be for me in future. And for that, of course, these private equity firms, they are basically established for that only. Their survival is with this model. This is their business model. They have to buy a company, they are acquiring a company, and ultimately their objective is not to run that business at all. Their objective is that in future we would sell them at profit. Suppose I am buying a company today at 100 crore rupees, and after some time I'm selling it at 150 crores. So that 50 crore rupees is going to be my future profit. Next one is mergers and acquisition model, and of course the name itself is indicating it is being used for merger and acquisition. It includes accretion and dilution analysis. I would only focus on accretion and dilution here. The entire objective of merger modeling is to show clients the impact of this acquisition on your EPS and how this new EPS is comparing with the status quo. What is my current position and what will be the impact of this merger or acquisition on my EPS. And what we call, simply put, if you ask me what is accretion and what is dilution, I would say that when your new EPS is being higher, the transaction will be called accretive, that it is the accretive transaction. Whereas if the opposite happens, if your new EPS is not on the higher side, it is on the lower side, we would be calling it as dilutive one. Last one is option pricing model. It is being used for that option pricing. You have to buy certain instrument at a specified price on or before a specified future date, and option traders, they are using it for call option, put option. They are basically using this model for setting a current theoretical value. So this is all about these models. I wanted to tell you about the different types of financial models which we are increasingly using in the area of accounting and finance. Although there are a number of models, I would like to tell once again here, I would like to reiterate here that there are a number of financial models which are being used in the accounting and finance industry, but the one which I have explained here, they are the most popular one. I hope you must have understood and enjoyed today's lecture of mine. Thank you so much.